Hey, what's going on, guys? And welcome back to my channel. This is arguably going to be one of the most important videos that I've made. In this video, I'm going to talk about how I'm personally going to be preserving my wealth, number one, as well as taking advantage of the upswing, number two, during times of a recession. And so there's been so many recession videos that are popping up on my feed, not just from smaller financial YouTubers, but also from really large and popular ones. And to summarize, there's basically a couple types of schools of thought, I would say. Number one, there's kind of the do nothing crowd and just keep on buying, which I think is totally solid. Like, honestly, if you guys can sit through a recession, and obviously I'm very young. I mean, I'm not that young, but I can't sit here and like lecture you guys like, yeah, if you can sit through a recession, you'll be fine. Like, honestly, I've never actually lived through one with my own money on the line, so I'm not going to act like I know exactly what it's going to be like. But just based on the numbers, it seems like if you can hold your stocks and then keep on reinvesting during that entire time period, that you're going to be in pretty good shape going forward. And you're probably going to be a lot better in the long run if you can do that. So don't get me wrong, I think that's a really solid strategy. And the other kind of school of thought is basically giving some tips on things that you can do. A lot of these tips, however, seem kind of like esoteric and they're not actually specific enough, in my opinion, to warrant some specific strategies. And so in this video, I'm going to give like specific tips, very tangible and actionable steps to take to really preserve wealth during recession and take advantage of the upswing. So yeah, the other thing I want to talk about actually is I did mention that I was young, and I am young, relatively speaking. Um, but I do manage about six figures in assets, and you guys have seen my Robinhood accounts, my or Robinhood account, my M1 Finance accounts with an S. I have a few of them. I actually have a mutual funds too, which I probably won't talk about in the future just because it's very hands off. But yeah, so I have different accounts totaling over six figures, and if I can take advantage of the recession on multiple areas, then I'm going to be extremely set up for the future. So I'm going to do my very best to do that. And in this video, I'm going to talk about how I plan on doing that. Now we can jump right into the video. So basically, what a recession is a downtrend at a very large degree. And the stock market is basically trends at various degrees. Let's go ahead and jump right into the charts. So this is the S&P 500 ever since the 2009 bottom. Let me go ahead and throw on some very popular moving averages, such as the 50 and the 200. So one thing is clear. If I go ahead and take out price action, you'll see that one particular moving average, which follows the price action very closely, and this one here is the 50-week moving average, you'll notice here that this moving average is either going up or sideways, up or sideways, up or sideways. And so a market can only do three things. It can either go up, sideways, or down. Generally, after going sideways, those periods tend to be consolidation periods, and it's not extremely clear what would happen after a market goes sideways. But at the moment right now, and this is in 2019, we are exiting a period where we just went slightly sideways for a bit. And so this is what I would consider to be consolidation. And so that's kind of why I'm bullish in the long term at the moment. So just to be clear, I don't think that there's a recession right around the corner like a lot of people are making it seem. But I will be cautious of that event possibly happening. And so let's go ahead and look at another moving average. This is the 200-week moving average. If I throw on price action again, you'll notice that ever since we got back above it after the 2008 recession, we never got below it. And every time price action approached this area, it acted as support. And all of those things are key in determining, in my opinion, if the stock market is in a recession or not. And so that's one of the main takeaways of this video is the 200-week moving average, in my opinion, is the most important moving average for determining if the stock market is in a recession or not. What if we looked at the same moving average for different time periods in the past? Let's say for the 2008 recession, what did that look like? A lot different. And so the way that we approached this moving average on the retest is a lot different than this time period here, for example. Here in 2008, what we did was we approached this moving average, we got a weak bounce attempt, there was a retest, and another weak bounce attempt, and on the second retest, this moving average could not hold, and so we eventually broke below it. What happened afterwards is pretty interesting. We tried to get back above this moving average, and after 4 consecutive weeks of failing, so that's 1, 2, 3, 4, after these failing attempts, what happened afterwards was a waterfall downwards. And so it's this type of waterfall event that I plan on avoiding. Let's go ahead and take a look at how much of a downside this exactly was. So if I take the entire size of the move, that was a 35% drop. And interestingly enough, this 35% drop happened in 4 weeks. So to put it in perspective, from peak to trough of the 2008 recession, which dropped about 56%, and this is the S&P 500 by the way, 35% of this 56% drop, which is over half of that drop, happened within 4 to 5 weeks. Like I said, this is the kind of move that I want to avoid. And so this is referencing part 1 of this video, which is how to preserve wealth. And so let's go ahead and take a look at the 2000 recession. Actually, it's actually slightly different in the sense that the drop looked different, but the same point is clear, and that's we couldn't actually hold above this moving average. Once it was determined that this moving average would not act as support, then there was clearly more downside to come, and the waterfall event happened here a little bit later, but it still happens nonetheless. And so it's the big waterfall drops that I plan on avoiding. One thing that's pretty interesting that I want to point out is that after these waterfall events, what we had afterwards was a lower low, and that's when the market found its footing. So waterfall events, market has a slightly lower low, and that's when the market found its footing. What this video is not going to be is how to predict the exact bottom. That's not what I'm going to talk about in this video. This is just thinking about how to determine if the stock market is in a recession and if there's more downside to come. I am not making up these moving averages. I think over the long term, the stock market will respect certain moving averages more than others. It's just what I'm looking at right now. This is the data. This is saying that when the stock market goes below the 200-week moving average and it cannot recapture that area, then there's generally going to be more downside to come. That's all I'm saying. It's not an outlandish statement. So what is my strategy here? Because it's enough to know, okay, yeah, maybe this is an important area, but what am I supposed to do about it? So given that, number one, I can't predict an exact bottom, I have to play my cards just right here. What I will do personally is sell everything. If the stock market goes below these moving averages, I will sell everything. And you're probably thinking, like, that's the dumbest thing I've heard of. That's literally the exact opposite of what you're supposed to do. If you sell everything, like, What are you doing? Well, the logic here is that number one, there could be a false signal. I'll give you that. There could be a false signal. In the event that we go below this moving average very quickly and then we recapture it, and let's say that the market just recovers, then you're right. I would have missed out on a few percent of dip because I would have bought the market potentially at a slightly higher price than I sold it at. But the other thing is that I would not have captured this dip. So there is that potential for a false breakdown, which I will completely acknowledge. Generally, on the grand scheme of things, it's probably not that bad. It just means that I didn't add money when I should have. But what I did do in the grand scheme of things is protect myself from a lot more downside. So if I miss out on like 2% of dip in order to protect myself from 20 or even 30, maybe even more than 30% of downside, I will take that every single time. So that's basically my step number one. And then after I sell everything, what I will do from that point is start to scale back in and start to average in slowly. This might mean that I start averaging in the lower we go. So maybe it might be a percentage kind of drop. It might also be a time interval kind of scaling in. So every week, no matter what, I'm going to end up buying a little bit more of my position. I plan on doing both of those types of scaling in. And I don't have the perfect formula for you because what works for me might not work for you. But the general concept is to start scaling back in slowly. So that's kind of the first topic of this video, which is how to preserve wealth so that you kind of can avoid some of these waterfall events. The second point of this video is how to take advantage of the upswing. And so let me go ahead and introduce you guys to a different set of moving averages, which are the 20 and the 120. This is on a weekly time frame. And so what these moving averages will help me determine personally is when to go back in aggressively. And so for those of you that don't know, I'm probably a gambler by most of your standards. I don't do what Warren Buffett does. I think Warren Buffett's a great businessman. I think he's more of a businessman than the stock market investor. I don't follow the advice that he gives to the general public, which is like buying good companies at great prices and stuff like that. I'm in it because I want to make a lot of money in a short amount of time, and I want to accelerate my wealth. And so given that I do use a lot of leverage, it's done very well for me over the past couple years since I started using leverage, and I plan on using leverage for certain time periods as well. And this is the part where I will just include a disclaimer, like leverage is not for everyone. I'm probably going to lose a lot of you right now, but I don't really care. I'm just talking about what I would do. Okay, so let's go ahead and see why I even included these moving averages. So the strategy here is very simple. These moving averages can help us determine when it's, quote, safe to come back into the market with very leveraged stocks. So when price action is below both of these moving averages and the faster one crosses below the slower one, then we are in a confirmed downtrend. And so this is an example of trend following. On the flip side, if the price action goes above both of these moving averages and the faster one crosses above the slower one, then we are in a confirmed uptrend. And so you might be looking at this part right here and being like, well, that's clearly a false signal. You would have been wrong here. But this only meant one of the criterias. This only meant the faster crossing below the slower, but it didn't meet the criteria of price action being below both of these moving averages. And so if I get deleveraged at this point and get re-leveraged at this point, that is a ton of downside that I am just avoiding. Similarly, if I get deleveraged here and get re-leveraged here, that is a lot of downside that I'm avoiding. keep in mind that this doesn't mean sell everything here and buy everything here, because obviously that's a lot of dip that I'm missing out on. That's why I have those two strategies. Number one, that strategy is to start scaling back in so that I can get the prices for as cheap as possible. And then number two, get into really leverage stuff at a different period in time. So yeah, that's basically the summary of this video. I'm pretty sure I'm gonna get a lot of weird questions, weird comments. Feel free to throw them onto me. Again, this is just my strategy. I don't care if it doesn't work for you guys. This is just sharing what I would do. So yeah, thank you guys for watching, and I'll see you guys in the next video.